2025 felt like the economy and markets were playing a giant game of financial chicken. That was the vibe of the 2025 economy. Investors treated AI stocks like a playground craze, throwing money at screens based on excitement rather than business reality. Look at the price tags. Nvidia is trading at 47 times its earnings. Palantir sits at 400 times. When valuations reach these heights, investors are essentially pre-ordering a future that hasn't arrived yet. Now we are stepping into 2026, and the market is splitting into three different levels. We could see a steep drop, an aggressive climb to the moon, or a confusing middle ground. So here's my 2026 market outlook and what I could see possibly happening. The case for a market crash starts with a simple observation. The stock market is currently operating like a large-scale 500-person school group project. This diagram illustrates a concentrated imbalance. While most are stagnant, 7 tech giants, the Mag 7, generate over 41% of returns. Because the index is market cap weighted, larger companies influence it more. As they grow, new money funnels back into them, creating a heavy loop. When indices become this top-heavy, if even one of those large companies stumbles, it doesn't stay isolated. The weight drags the entire index down with it. Statistics suggest we are due for a 10% pullback about every 3 years, but betting against the market on a whim is a risky move. This portrait shows John Maynard Keynes, who famously observed that markets can remain irrational longer than you can remain solvent. All it takes is the Mag 7 stocks to stumble for the whole market to slip. Of course, the market can ignore historical averages if the conditions are right. If the tailwinds are strong enough, prices can keep rising, regardless of the risks. This is Jerome Powell at the Federal Reserve, essentially the school principal who is deciding to hand out extra recess by lowering interest rates. Lower rates mean capital is cheaper to borrow. When money is cheap, investors are more comfortable paying a premium for stocks, which helps the market valuations climb higher. This view of the U.S. Capitol highlights where fiscal policy begins. It's essentially how the government uses its budget and spending to influence the economy. By running a $1 trillion deficit, the government pumps money directly into the system. This supports consumer spending and keeps corporate revenues high even when other data looks weak. Even if growth cools, the fiscal backdrop remains supportive in the short term, and that matters. When concentrated risks meet a flood of government-backed cash, the result is often a confusing, unpredictable gray area. I'm talking about a long, choppy, sideways price action year. In a choppy market, headlines flip every 2 weeks. Rallies stall out just as you get confident, and the price drops are scary without ever providing a clear entry point. This is the hardest environment to survive because it punishes impatience. Investors often make mistakes trying to force a win when the market is simply moving sideways. The reality is that nobody knows what will happen next. Anyone claiming total certainty is likely trying to sell you a shortcut that doesn't exist. The best strategy for 2026 is to keep your eyes on the screen, absorb as much information as possible, and then come to your own conclusions.